Good evening, everybody. It's Richard Answer here from Once Wills and Trusts. So we are live. Should be on YouTube, should be on LinkedIn, Facebook, and Instagram. So just sorting out a couple of bits and then we'll get cracking on. I think we're having some issues with Facebook, so that's not a problem. We will just crack on. Get started. So first of all, if you can hear me okay, just type in a Y in the chat box. It should be somewhere if you're on LinkedIn, beside your screen or underneath your screen. Same if you're on YouTube. Then we're going to go live on Instagram. And for those who are on Instagram, the view may be a bit small. So feel free to jump on it, YouTube. I'll put a link to the chat now, and then we're going to get started. So if you're on Instagram, you should hopefully receive a in the chat. We're going to get started. So tonight we are talking about the 5 things couples should know about inheritance tax. I'm quite excited about this. So allow me to kind of teach, which is my passion, to equip families, individuals, couples, parents, to be more financially astute in the area of their wealth. And that includes inheritance tax and why planning is so important. Okay, so I'm going to be sharing my screen. So let's get started. Make sure you can all see me okay. Brilliant. And so again, if you are just joining us and you're on Instagram, it might be a little bit small. So feel free to jump on Facebook and you should have the link in the comment section. At least I hope so. Just going to check one more time and then get started. Brilliant. Right. So the link is now in Instagram and I'm going to get started. Right. So 5 things couples should know about inheritance tax. I'm going to go through 5 points. So the first point is, what exactly is inheritance tax? I've made some notes here, so don't go astray because I can talk for England. How is it actually calculated? And we're going to go through the different allowances that you should be aware of. Couples who are married, okay, we're going to go through that. And then those who are married in civil partnerships, and then couples who are not married. So we've classical common law couples, or just living together, but you're nice married, and what the differences are, what you should look out for, and how that has an impact on it on just tax planning. Okay, so just to make sure everyone can hear me okay, the recording is going to be good, and then we will crack on. I want to hear them hear you speak. So that's the main thing. All right. So I'm just making sure I'm not hearing a third party sound, so you're not hearing me 2 or 3 times. Just give me a second. All right, that sounds fine. Cool. All right, so let's get started. So, what exactly is inheritance tax? It is, in layman's terms, a tax that is levied on an individual if, and technically speaking, if there's a transfer of wealth. Okay, normally, if that transfer of wealth occurs, but it can also take place and be levied during lifetime. All right, we're going to focus more on what happens and takes place. Um, and on top of all of that, there are levels of allowances that everyone should be aware of as to when this event will actually kick in. So, could we can transfer wealth all the time, but is there a certain amount that should be that will trigger this allowance? This will trigger the take place. So everyone's probably heard this famous number that hasn't changed in donkey's years of 325,000. We call that the nil rate bands. Okay. Everyone over the age of 18 has this allowance, right? You're over 18 and you hear the sound of my voice right next time, or certainly anything of value in your lifetime, then you have today, and you had made a gift of some amount of the amount that's gifted, and this allowance for 25,000, that difference typically is subject to inheritance. Okay? So, an inheritance tax at the moment is at a rate of 40%. So, as you can see, it's quite a big hefty sum. So, how do we change that? How do we, especially as couples, it's a big deal, all right? Because wealth can be accumulated quite quickly. And you want to make sure, especially as parents, you want to pass your wealth down to your loved ones. Normally, we as parents, we work hard because we want our children to get the best. We want them to benefit and do better than us from a generational standpoint. And so, therefore, we want to accumulate as much wealth as possible. But as I've always said, and one of the things that what we believe in, why we even call ourselves one in the first place, is that the secret to wealth is to own nothing, and control everything. But wealth is not how much money you make in life, it's how much money you keep. So the focus is making sure that as much of that wealth that you're generating passes down to who you want it to go to and not go to a third party, or be lost through taxes because of ignorance or no knowledge or lack of any form of advice. Okay. So it's very important that we understand what's going on. So having said that, that's the most everyone would have that allowance. Um, but then if you're parents, there is another allowance that you should be aware of. Okay. Um, and ultimately, we call this the residence or residential. real rates band, okay, or the RNLB. Excuse my doctor's handwriting. All right. And at the moment, as of today, that's an additional £174,000. But the question is, well, who qualifies to receive this? All right, who qualifies? So let's go into that a little bit more. The reason why I'm layering this so you can have an understanding, okay, and then we can get into the nitty-gritty a little bit more. So who qualifies for this allowance called the residential nil rate? So yes, beneficiary parents. But what does that mean? So you could be um, of, of your children, so your natural children, um, foster children will count, adopted children. If you're married, then stepchildren, okay, and also grandchildren. All right. So these would qualify um, as a qualified lineal descendant. And so it's important that we know this because it won't include nieces, it won't include nephews. Um, and so we just, and if you're not married and you're in a mixed relationship, where there's children from from previous relationships and you're living as a family, um, you know, especially if you do not have a will, it can really cause complications. All right. So we're just trying to make sure that that premise, you we plan correctly for you. Okay, so let's go a bit deeper. So we talk about who qualifies for residential grant. So part of the qualification is yes, you are a parent. Okay, and then we looked at all these qualification factors that would stand you in good stead. The other part of the equation is that you are or have been a homeowner. Okay, but not just that you're a homeowner, but you've occupied it. Now, the definition of occupation is quite loose, but you can prove you lived in a property at some point, at some time after April 2017. Okay, right. So once you go past that date, and you say you've owned the property at some point before a death event has taken place, then it's then you can say, well, I've occupied it. All right. So the length of time you live there is not really that relevant. It's just you just need to prove that you've occupied the property at some point and you've owned it. If you're married, there's more benefits, which we'll talk about later on. So this is two criteria. So I'll just recap just to make sure you understand that. 25 for the residential nil rate band. Okay, so just if you're just joining us, I'll just go back a little bit. Okay, we're talking about inheritance tax, we're talking about being a couple and families and why it's important to know this. Okay, um, there's an allowance called your nil rate. Okay, this is anything over this amount, which is 325,000. You're over the age of 18 and you're hearing the sound of my voice, you have a nil rate. Okay, you qualify. Again, just to repeat, if you're on Instagram and this looks really small, I put a link in there. You can just join us on YouTube if you want to see a bigger screen. All right, just to let you know. So just to recap, so if you are over the age of 18 and you have an allowance in the rate band, it's 325,000 as it stands at the moment. It hasn't changed, I think, since 2009. Don't quote me on that. It's a long time. Okay, so it may change one day. At the moment, it's £325,000. Everyone has that over the age of 18. So if your wealth exceeds this amount and a different place, I want to use the word yesterday because I don't want to jinx. But people get funny when it's about death. So if someone died yesterday and their wealth exceeded £325,000, then the difference between what their wealth is, let's say it's £500,000, and the allowance of 325, will be taxed at 40%. All right, so that's just a basic. Okay, and we now there's another allowance that families should be aware of for individuals. Okay, which is called a residential nil rate band, or I call it RNRB just for short, and that's an additional £175,000. Okay, for that individual, but there's a bit more complex in terms of how to qualify for that. So the first part of the qualification is that you are a parent. And what does a parent mean? So you have natural children, you have a foster child, adopted child or children, stepchildren if you're married, okay, or grandchildren, right? So it's quite a wide definition of uh, child, okay, and that's called a qualified lineal descendant, all right? So not nieces, not nephews, okay, or not someone who you treat as a stepchild, but not officially your stepchild, or treat as a foster child, but not officially your foster or adopted child. So just be very careful around that. Okay. The second part of the qualification is that you have owned the home or you currently occupy and own the home at this present time. Okay. Um, and the key date would be after April 2017. All right. So as long as those two factors, then you're on the right trail. Um, those are the two main ones. The third one, which you don't really have much control over, it's more that your personal representative or executive, and I'll go into that in a little bit, that it needs to be claimed within 2 years from the date of death. This is where it can trip up a lot of people because there's no legal time limit to apply for probate. That's actually done at any time after the event. It can actually be lost if it's not done properly, hence why planning is so important, and have a document that gives instructions to your executives or personal representatives is super, super important as well. So we'll go into that a little bit later on. Right, so on the assumption you qualify for that, um, then it's £500,000 that allowance that you have, okay? Especially 500,000 before inheritance tax is 40%, okay? If a death event takes place. It can be done during life, but I'm not gonna go there right now. All right, if you have questions, feel free to drop a comment, I'll answer it as best I can. So, on that premise, we've now established, well, what is inheritance tax and who can qualify for it, for the allowances, and when would it be triggered rather, okay? Now, on that premise, we're gonna look at different kind of scenarios, 'cause it's really important that we get this. So, let's look at couples who, uh, are married. We're gonna look at couples who are not, but let's start with couples who are married. So, typically what happens is, and we're just it's just scenarios, everyone's situation is different. You have a couple, they own a home, and let's say they have children together, okay? Um, and let's look at the scenario where there's no will in place. So the home could be worth, let's say, in London, let's just argument's sake, £500,000. It could be a mortgage on there of, let's say, £250,000. So their net wealth at this moment in time, just based on this picture of what I've shown, is currently 250,000. All right. But then let's say, mum works, dad works, this is owned in joint names. So mum has, let's say, savings, just £10,000. They've got a joint life policy, life insurance policy, say £500,000. Okay. All of a sudden, well, what is their estate? What's the value of their estate? And they say, Mister, say he's got some savings, say £2,000. He's got a nice car worth, £20,000, loan maybe £5,000 on it. And let's say he has some investments at £50,000. All right. So savings, car, investments. Okay. So when we look at the overall net wealth of the family, again, they're not married. If we kind of total that all up, so that's, I'll be flicking through pages. Give me a second. I've got the family home, so that's 500,000. There's a mortgage on there of 250,000. We said that this is has savings of 10,000, and there's a joint life insurance, so between both of them of £500,000. Then we've got Mr.'s got savings of 2,000, and he has a nice car. So 20,000. There's a loan on it of 5,000, and we said, if I missed anything, he's got investments of £50,000. So when we look at the value of the estates, of their estate combined, we've got 500, 750, take off the loans, don't include the loans, estate, 760, 80, 830, 832. Got that right. Just double check. Should have been a bit better earlier, but it is what it is. So 500 million 250. Right, I can't add, so I'm gonna go with 8. Let's call it 850. If I'm wrong, I'm wrong. Don't 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 ever go at me for it. We use 850,000. Now, for combined wealth of £850,000, they're under their £1 million threshold. Where do they get £1 million from? Well, let's explain. So with married couples, there's some benefits which are for inheritance tax purposes. Okay. Before I go into that, this couple do not have a will, so there's no will. So what happens if someone has if someone has someone who dies or passes away yesterday and they have no will, then they've said to have passed away intestate. They've got no um, wish. Their wishes are not stated, so the government implies a wish upon them, implies a wills upon them. I call it a government will. All right. So if you die without your own will, the government gives you their version. Everyone I've asked so far, if they're happy with that, it's always been a big resounding no. So in this instance, I've combined the wealth for 850. If you're just looking at it from individual wealth, um, then it's gonna be an interesting scenario what happens. The house is in joint names, and when you've got property in joint names, when the right scheme, it's passed down to succession. Okay, so whoever survives receives the house. All right. So I'll just put that again so you're aware of that. If you got a property, the said the value is worth £500,000. Instances 250,000, and it's in joint names between Mrs. and Mr. If Mrs. passed away yesterday, then Mr. owns the house 100%. All right, and vice versa. Now the challenge is, if there's no will and there's children, so there's two children, then the rules of intestacy are quite interesting. And obviously, their wealth is much more important than just a house. Okay. But we have to look at the individual who passed away first. But the rules of intestacy for an individual, if you're married, is that £322,000 go to the surviving spouse, and then everything else is split 50-50 between the surviving spouse and the children. Now, if the children are under the age of 18, then that goes into trust, an absolute trust, and it can make it quite messy, because, well, if depending on who the personal representative is, more than likely would be the father, but it may not be in this instance. But in terms of selling the house, maintaining the wealth for the children, not all of it belongs to the spouse, and potentially inheritance tax could be due on the first death. So it makes it very messy, and it may not be in line with what you would have want, okay, as a couple. So it's important to have a will in place. Now, looking back on this particular example, this couple had a lot more than just a house. Okay, so the house has gone sideways. The surviving party, we said it goes to Mr. in this instance. Mrs. has savings of 10 grand. She's got a joint life policy, so that pays out on the first death in this instance. So then Mr.'s now inherited half a million pounds. So his wealth is now increased. Got a house of half a million pounds. He's got £500,000 cash. Okay, that's already £1 million less the mortgage on it. He might pay the mortgage off, which is ideally the ideal thing to do, but he's got money, right? Plus his own wealth. Okay. And then, but out of all of that, 50% of £322,000 only belongs to him, and the rest is split 50-50 between him and the children. So it doesn't really work very well. Now, this is a very simple example because I've just used the fact that this couple has children together. But there are many relationships where the children may not be together. Where there's children from different relationships and you're living together, as a married couple. And so what happens then? Okay. So Mrs., for example, had children from a previous relationship. Okay. I'll me paint that in yellow, just cover it there. And the same example took place with no will. Okay. Then, and then they've got children together. It's an interesting scenario. So if the house 100%, well, let's say Mr. has the house because it's just in his name now, and he has his own children, and there's children from a previous relationship that he may or may not want to consider as his own. We don't know. And let's say he decides to remarry. Okay, it starts to get very complicated. These children may be disinherited because the wealth, which by rights, maybe half of it should belong to these children. Uh, but Mrs. like, well, yeah, it's all good. I'll look after them, but nothing's written down. There's no will. He remarries. Maybe he passes away before the new spouse, and so the new spouse may not consider his children. So they could be disinherited. Okay, so we got to look at the bigger picture. That's what I'm trying to say. So having a government will may not always be the best solution. Nine times out of ten, it really isn't. And then inheritance tax is paid on the first death, um, potentially, and inheritance tax will be paid on his death. Um, if his wealth exceeds 325 because they're not utilizing any tax planning at all, even though they're married. And then if another spouse comes in the mix, it could be a predator, we don't know, then they could inherit some wealth as well. So how do we kind of stop that from happening? Yes, you need a will, but let's look at inheritance tax as well as the planning as well. So if we look at it from an ideal point of view, um, find a nice fresh thing, let's look at someone with a will. Okay, and let's talk about why married couples in particular have a big advantage. Okay, number one with married couples, they can gift to each other unlimited. Okay, that's number one. They can make unlimited gifts. They're called exempt beneficiaries. So America, a couple could give hypothetically £10 million. You know, the wife would give £10 million to the husband, free and clear of any inheritance tax during their lifetime. But if they give it to their child and the death event took place within 7 years of that gift, there'll be inheritance tax, right? But if a wife decides to give to her husband or vice versa, and that party died within 7 years, there's no inheritance tax. So that's an advantage, right? So unlimited gifting between couples. Number two, um, we can combine their inheritance tax allowances. So that £325,000 I was talking about, well, as couples, um, when I say combine, whoever dies first or passes away first can transfer their allowance to the surviving spouse. So their £325,000, for example, they haven't made any gifts in their lifetime, can be transferred to the surviving spouse, so now they've got £650,000. And then that £175,000 we talked about, the residential nil rate bands, RNRB, exactly the same. Okay, the spouse, whoever passes away first, can transfer their allowance to the surviving spouse. So now they've got £350,000 or 20% of the allowance, okay? So the combined allowance, all things being equal and there's no other anomalies, so everyone's situations will be different, all right, is £1,000,000 rather than discrete amounts of £500,000 each. And the inheritance tax is paid on the second death, not the first death. So there's more time for planning, um, there's more time for, just yeah, just more time for planning basically and making sure that, if there is an inheritance tax challenge potentially, then things can be done to reduce that down as much as possible, okay? So most couples are not aware of this. Most couples who I see who do have a will, nothing's been discussed. Bearing in mind it's the residential new ban came into play from 2020 onwards, and so most people still don't have an idea. When I see wills within the last 2 years, they're not being discussed, they're not really being challenged or talked about, for whatever reason. I'm going into that today. But as an individual contemplating marriage, as an individual who's maybe living with somebody, as a family, as an individual who's currently married, you need to be aware of this. And you need to ask yourself the question, well, if we look at our wealth or your wealth and you combine it all together, you have a potential inheritance tax challenge. We've got a calculator on the website. You can definitely use that if you wish. Um, and that will help you to decide, at least that you have to look at what's going on. Um, and then you can make a decision about that. You can start taking more action around that as well, especially if you've got life insurance, if it's not put in trust, which I can discuss shortly, that's gonna add to the value of your estate, okay? I mentioned earlier about joint life policies, you know, they are yeah, I get the notion around them, but they can be a bit challenging when it comes to inheritance tax planning, because what you notice is that it pays out on the first death, but when I'm doing the calculation for the estate, we don't know who's the first person to die. So I have to include it in both people's estate because the wealth could be on either side. We don't know. And so it causes a big, big problem. We can't put a joint policy in trust, just because it just doesn't work unless it's the second death, and even then it's still a little bit dicey. So most policies are paid out on the first death. They're joint policies. It's very difficult to mitigate with inheritance tax. It's a very simple thing to do. Whereas if you've got policies in individual names and they're in trust, it's outside of your personal estate. That reduces your estate value for inheritance tax purposes, and it just makes life a lot more easier in so many ways, especially when it comes to paying out really quickly and paying out to whom you want to go to. So you have control in the direction of where the wealth is going. All right. So ultimately, as a married couple, there are a lot of advantages, but those advantages will only be taken into consideration if you have a decently drafted will, or you got very switched on, whether you would be a personal representative to try and do things, sort things out extremely quickly if a death event takes place. And even then, it might be too late once a death event takes place. So it's just better to get it out of the way during your lifetime, so you've got a peace of mind knowing who's going to receive what and when. Okay, especially if we call blended families, which is becoming more and more commonplace, where there's children from previous relationships, families are coming together as one family, which is perfect. Everyone uh, is in that kind of scenario. It's not everyone, but a lot of people are in that kind of scenario. And if the planning's not done correctly, it can really lead to horrible disappointment and argument and all that kind of shocking stuff that takes place within families, just because of a lack of planning. Okay, it's just not good. So we need to do something about it, and that's why I'm doing this training today. Okay, so in regards to um, couples who are not married, all right, and I am taking questions if anyone wants to post the questions. So please don't feel. Obviously, I'm only what I can see. But if there's anything in the replay, I'll definitely come back to everyone on that. For couples who are not married, um, it's important that we understand the situation. If you own property in joint names, okay, and I'll go into property ownership in a second, but if it's in joint names, so in other words, you're both named on the property, and definition of joint names basically is you're jointly and severally liable for mortgage, and even if there's no mortgage, you own the property 100% each. All right, and so that can, for planning purposes, it's not the best. Okay, so again, if you've got couples together, in this instance, who are not married, whoever passes away first, then that 100% belongs to the surviving party. Now, when you're not married, and there's children, as I've already shown you in terms of the allowances, well, you can't combine your allowances. So, surviving spouse will just have their own allowance. The deceased would have their allowance, which is 325 nil rate bands and £125,000, um, assuming the house has enough value in it. Which, in this, if you use it at £500,000, then they can claim the full allowance, residential nil rate band of 125,000. He has a £500,000 allowance. If his wealth exceeds that, then there's inheritance tax on the first death. Now, the problem is this: if there's no savings, if there's no life insurance, if there's the risk of how do we pay off the debts, how do we pay off any liabilities, if there are any, okay? Um, how does a surviving spouse survive if the deceased was the main breadwinner, for example? Um, how do we continue to live the life that we were living before if there's no provisions in place? Okay, that occurs to any family, whether you're married or not married. But it's important that we understand this um, situation as well and why it was important. With regards to not being married, because you're limited to £500,000 and inheritance tax is due 6 months after a death takes place. If inheritance tax is due, the big question is, well, where do you find the cash to pay it, especially within 6 months? And most people think, oh, I'll just have to sell out the house, unit, or sell a property if you've got more than one property, or if there's a life insurance policy and it's not in trust, again, it can cause problems because it will not pay out until probate is granted. Probate is means to prove, so the government wants to establish the wealth first. That could take up to a year before that piece of paper is actually granted legally. So we know what the wealth is now. We're happy. Uh, Continue with selling the estate, etc. Well, if that takes 12 months and you need the cash like yesterday, then what do you do? Yeah, there's problems that can arise. So it's really important that you have everything in place. All right. And again, if you're not married, keep stating this, and you're just limited to your £500,000 allowance, and you've got a problem on the first death rather than maybe delaying it for the second death to take place. So just the act of getting married can save a lot of hassles and introduce more tax planning. Okay, so just making that that point to think about. All right. nothing to think about. So that's the difference, really. Having properties in joint names is a challenge for inheritance tax planning, especially for couples. And so what we recommend is normally to kind of theoretically, we can imagine split that property in half. So the ownership is now 50-50 rather than 100-100. Now there could be anomalies. So if someone put in more of a deposit than the other, then it might be a different percentage, but normally that's done on purchase. But most couples, if it's in joint names, we can just do a simple split of the tenancy without affecting your mortgage or anything else. It'll be a 50-50 split. And the reason why that's a good thing, again, if it's owned by couples, excuse my drawing, then now you can direct the wealth, control the direction of the wealth individually. Now, this is perfect, especially for couples with children, especially children from previous relationships, because you can within your will, the government won't do it for you, but within your will, if you get the right type of will, you can always ring fence your half and make sure it goes where you want it to go. All right. And most people do the planning to take advantage of, if you're married, is take advantage of all the tax perks that you get. You direct it to your spouse first, but because it's in a trust, once that spouse passes away on the second death, the wealth is going to your children. There's no question. No one's going to be disinherited. All right. On whoever passes away first. So let's say Mrs. Predeceased the husband. Yes, the husband can still live in the house. If you've got life insurance, you've got planning to pay off any mortgages that may be on the property. But ultimately, the wealth now stays, eventually will stay in your half. It's not going to go 100% to the surviving spouse. So if the surviving spouse decided to get married again, even if it was in a predatory nature, right? If he was to marry again, well, it's only his half that's going to be affected, not 100% of the property. So you've got 100% assurance that your children will always benefit. But you must have a will in place because it's your wishes, not somebody else's wishes that will take effect, and the planning will be done. Okay, so it's important that we understand this, and because couples can give to each other unlimited amounts, you can do some excellent planning within the will. Because couples can transfer their allowances to each other, um, then you can increase the amount of wealth before inheritance tax is due, which is uh, beneficial. Even if you're a widow, you can still claim you're still deemed as married. Okay, so therefore, if you're not divorced and if your um, the partner has passed away, a married spouse has passed away while you're still married, then you're deemed a widow or widower. You can still claim the allowances, the residential nil rate band, and the nil rate band. So you still have £1 million allowance. Okay, so it's important you're aware of this so that you can take advantage of this and ask the right questions when you're going to take instructions or going to, want to make an informed choice, that you know what you want, that what needs to be done. Challenge advisors and make sure you get the right type of advice moving forward. So important that we do that. Okay. Um, and I think I've exhausted this. Yeah, I've covered pretty much everything I wanted to say. So those are the 5 points. So just to recap, we've talked about, well, what is inheritance tax? I'll just abbreviate it. Okay. How do you determine how or how much or how do you know when inheritance tax is due? Or if you actually have a challenge at all, um, as to what the allowances are. Okay. We talked about couples who are married and the advantages from a tax point of view. and also some of the perils that can take place in terms of way that certain things are owned. And it also talks about couples who are not married, and again, some of the perils and challenges that can take place because of lack of tax advantages that could be available. All right, so it's just again keeping you aware of what's going on. So those are the points I wanted to raise for couples in a relationship. Okay, whether you're married or not married, that's totally up to you. But at least you now know the rules of the game. So it enables you to play that game much better now that you're aware. All right, because the choice is now yours. What to do. I'm gonna end it there. I've been waffling on for a long time as it is. Any questions, feel free to post it in the comments below. Um, the replay will be available to you as well, and reach out to us if you've got any other questions as well. We're on pretty much most of the socials, so check us out from there as well. Thank you for your time. I appreciate it. Have a good evening. Thank you.